let's move on to the next article today, guys. We got mortgage demand. It's also from CNBC. We got mortgage demand falls to the lowest level since 1995 as interest rates near 8%, but that was on the day that they actually ended up hitting 8%. So mortgage purchases applications have dropped. You have refinance applications which have also dropped. And I don't want to just go down the path of it only dropping. I want to talk about some opportunities too, guys. So, even though the average contract for interest rates on 30-year fix are substantially higher now than they were a year or two ago, they're even higher than what the projected rate by this time was going to be. Remember, by this time of 2023, said, quarter four 2023, we'll probably see mortgage rates at 5.5%. We're clearly well beyond that, and it does not even look like we're returning anywhere close to that in the upcoming months and even maybe the next quarter. So yes, of course, applications are down. Yes, it's a byproduct of the rates. Yes, it's a byproduct of the inventory. But I want to talk about mortgage applications that are working right now. So let's talk about some of the scenarios that we're seeing here at the office with people where they're like, hey, I'm raising my hand. I need help. And I'm going to ask for help from you before it's too late.
Again, we're going to go back to that 3-1, 2-1 buy down, or even that 1-1 buy down. These are actually difference makers right now in today's market. Those are the things that are actually helping us out. So thank you, sellers, for considering helping buyers get into their home and making it affordable in the first 12 months of their payments. And the reason I say that is because if we're doing, the most common one is a 2-1 buy down. Let's just, for example, say the interest rate is 7.625. Well, for the first 12 months of their payment, their interest rate's going to go 2% lower, which will go down to 5.625, right? And then that's for 12 months. On the 13th payment, then it'll go to 6.625. And it's not an adjustable rate mortgage. This is a 30-year fix. And so this gives and encourages the consumer to go out there and say, I can do this.
Yeah. Well, can I just add something to that?
Please.
So when you're qualifying for this 3-2-1 buy down, do you have to qualify at the regular rate and then?
Well, that's a great question, Mikey. So yes, because it is considered a 30-year fix, you're going to qualify at the full rate, which is 7.625. All it is the 2-1 buy down is we're allocating the difference in payment of your interest rate of the 5.6 and the 7.6, whatever that difference in between of that payment is, we're allocating 12 months of those payments and put them into an escrow account so that the bank, as they make your payments, you really are making a payment based on 7.625. Right? So it's just money that's getting allocated in a different escrow account.
Yeah, and that's a really good point, guys, because if you're thinking of buying, you're not sure, what's the horizon look like in the next year, 2, 3 years? This is a way you can do that where you're qualifying at the full amortized payment, but your actual monthly payment will be substantially lower than the market rate now on your way into home ownership. And to regurgitate another point that Memo had made on a previous show, when he bought his first house, that payment was a little bit tight in the beginning, but as he earned more money and paid down other debts over the course of time, that monthly payment became less compared to their income. Correct. And also when the market turned around and rates went down, he refinanced out of that. Yeah. So the mortgage payment ended up going into a lower fixed payment as the income also went up and gave a lot more margin and flexibility. So if you're looking at this from the short side of the conversation, that's also a disservice to yourself. Look at buying a home and real estate from the long view of what does it look like to be here for 10 years or maybe even 15 years. That might actually be the best thing for your life beyond what looks best on paper.
Correct. And hey, again, you qualify at that interest rate, and then that way we know you're able to maintain that payment. So we're not qualifying at the lesser rate, and that's why it's important that we have these rules in place so we don't see what happened back in 2008-9, the mortgage meltdown.
And something else I wanted to bring up too, specifically because here in San Diego, we have a lot of people who PCS and they get orders to come here to San Diego, and they intentionally buy a home here in San Diego. So especially for you military couples where you are both enlisted or you're both officers in the military, this would be good for you to consider coming to San Diego because those combined BAH allowances that you get for housing typically supersede the cost of what it takes to get a mortgage here in San Diego. But the minute you PCS out of San Diego, there's someone coming in right behind you that's going to need a place to rent and may not want to buy in San Diego. But their BAH will cover what the commensurate rent would be in town on the place that you own. So keep that into consideration if you're already in San Diego and you're married and you're enlisted, or if you are coming to San Diego soon and you have your VA eligibility. That is something you should consider when looking to get a home here in town.
Yeah. You know what's crazy about it? Even with the interest rates as high as they are, Mikey, we're still we are still seeing an increase in the sales price of homes. You know, people are still snagging them. The other thing is that was just announced that Fannie Mae, Freddie Mac, now our new San Diego County limit has gone up from that 726, conforming loan limit to now 750. It used to be, I don't know if you remember that time, Andy, where we would see 417 every year for many years. It wouldn't even go up.
Yeah, 417,
And now since 2000, I want to say, I'm taking a guess here, don't quote me, but since 2012, we've been seeing those county loan limits increase every single year.
Yeah, it wasn't too long ago. It was like 589, 250 or something like that.
Yeah.
So, I mean, that's really far in the rearview mirror, even though it wasn't that far historically.
Yeah. And what that actually means to the normal consumer, conforming loan limit at 750, what it is the interest rate, it's more in your favor. Why? Because this kind of mortgage bond, when we do a mortgage, it'll become in the secondary market as a mortgage-backed security. So we're able to sell almost like if it's cash. There's so many investors that are willing to just to buy that out.
Yeah.
Once you go above that, now you're trying to work for look for a more aggressive investor that you can sell to.
Yeah. Well, there's going to be other things that come up too in the market where maybe you're watching the show today and you're like, oh, I already have a house, so I don't need to qualify to buy one. But we've recently been talking a lot more about using the home equity line of credit or the HE loan, also fixed second, in order to access cash, get yourself a line of credit, so you can do things such as consolidate debts if you have them. If you need to pay off some sort of other thing in your life, whether it's another loan somewhere else or a car or a motorhome, a boat, things like that you want to keep, or if you need to do a garage conversion or an ADU or add square footage to your house or remodel, maybe you have deferred maintenance you haven't done. It's going to be 30 or 40 grand to build a pool if you don't have one, like whatever it might be. That might be a good way for you. But you're like, hey, wait a minute, Andy, I thought rates are super high. Yes, but it's proportionate. I'm going to go back to the point I made earlier. It's relative, because if you have a 25% rate on your credit card, I'm pretty sure a home equity line of credit at 12 is going to be much more favorable. And even the loan amount on your home equity line of credit is going to be much smaller compared to your first loan that's fixed at 2.5 or 3 or 3.5. Yeah. So your blended rate effectively could still be 4.5 or 5 or 6 when you compare them all together and you put all that money in the same pot, but your out-of-pocket expenses are much lower. And the reason I'm emphasizing this today on the show, guys, is because I'm starting to hear things and talk to people in financial planning, taxes, and even some of my attorney friends where they're saying, hey, people are starting to have some struggles in their personal finances. Their budget isn't adding up, but they own a home. What are some of their choices? And so I know privately what's happening is people are having these challenges, but those conversations need to come out of the dark, out of the shadows, and come towards us so we can help you find solutions before you inadvertently put yourself in a position where maybe you can't qualify. Is
Absolutely.
that fair?
Yeah, fair enough. No, that's great advice. And again, there's a blended rate. Don't touch the first. If the rate's really low, you don't need to do that. The good thing is there's other options. And like you mentioned earlier, there's a HELOC, home equity line of credit. Works kind of similar like a credit card. It's an open-end loan. So you pay it off, you use it multiple times, then you have HE loan over here, like Mikey over here, HE loan, just buff guy, right? But you got options there. And so utilize those. And the cool thing about that is if your rate is 12%, and you're on the second and the first is at 2.25%. Well, there's a blended rate. It'll probably be like 4.25% altogether.
Yeah.
So when you do the math, it's a good way to do that. And especially if you're investing in your home or you're creating that ADU, guess what? That interest becomes a tax write-off for you. Again, I'm not a tax person. You'll have to find out what you're able to write off. But I know on a credit card for sure, I don't have that luxury of writing that interest off.
Will, you know what I was wondering?
Yes.
So I know you're talking about 2-1 buy downs and stuff, but would you ever recommend an ARM in any case to someone?
Yes, I do recommend ARMs. The only bad thing is ARMs are almost prehistoric right now, but absolutely an adjustable rate mortgage, I would certainly do that. If it's a 5-year or a 7-year and it gives you a better rate, 0.5% or more, than a 30-year fix, use that. Because we already know in another year, 2 years, we're going to refinance because rates have to come down, right? And there's a saying, what goes up
must come down.
That's it, and it's going to happen. It's just a matter of when.
Yeah, it's a good question, Mikey. I think there's a threshold for where that makes sense. Again, on the timeline of what, how long someone's going to stay in the house, and then what the market conditions are. Because also with the ARM, you may not actually have to refinance out of it when it becomes adjustable. Here's why: when the Fed starts walking back down their Fed funds rate, that ARM that you got maybe at 6.5 becomes 6.25, becomes 6, becomes 5.75, becomes 5.5.
Yeah.
So you could actually find yourself in a situation where by getting the ARM today, you're at the perceivable top, and then over the course of time, it actually marches its way back down the steps because they're reducing interest rates. So it would be in your favor actually to have an ARM in that scenario. It is rare, but the bank has to be willing to play in that, and so does the borrower. So.
Correct.